Okay guys, so a very good morning and a happy Friday to you all. I'm going to get straight into things with the big news that was overnight. I'm sure most of you have read the headline by now, but the Bank of Japan surprised the markets. There was, I think, about 4 analysts out of 30 or so that were surveyed that were looking for a potential move on their QQE program. Absolutely no one was expecting them to move interest rates. Kuroda is growing a bit of a reputation for being a bit of a right at the last minute, changing his mind on things. And this vote in particular to take interest rates into negative territory at the Bank of Japan and minus 0.1% was an extremely close call. It was by no means unanimous in terms of the actual board members of the central bank. The result was 5-4 on a majority vote. So first chart I just want to show you here is about kind of the market's pricing and the fact that then this was such a big surprise for the overnight session. This is a 30-minute chart of the Nikkei. So you can see here, this is the main candle when the news broke. So we did see gains. I think at the time it was around 6% move higher, that was. And then in the end, we did pair some of those gains, but we pretty much finished around 3% higher in the Nikkei index. And then the Japanese currency, so this is dollar yen. So this is showing yen weakness. Again, you can see an incredible move here. I think this equates to around 3.5%. So on one piece of news, for it to move that much, again, I think for some of you new guys, you need to understand that these are unprecedented type news stories that are breaking at the moment. Again, Japan going to negative interest rates is a fundamental change in terms of their approach in monetary policy. As such then, that kind of sentiment has fed through to Europe. We'll get into that shortly, just to kind of go into a bit more context in exactly what the BOJ have done here, because there is a slight subtle difference between their negative interest rates comparative to what we've seen by some European central banks, the ECB being one, with their negative deposit rate. So in terms of the BOJ, they'll lower the short end of the yield curve by cutting its deposit rate on current accounts into negative territory. Their goal here is to exert further downward pressure on interest rates across the entire curve. So that's targeted at the short end. They're looking to move the entire yield curve lower, and as such, create this kind of stimulus or stimulated environment. However, the difference is the Bank of Japan are using a complicated 3-tier system, which makes the negative rate much weaker when comparable moves by the ECB and other European central banks. So essentially then, the reason why what the Bank of Japan has done is different and potentially not as impactful as what the ECB has done is that they'll only pay negative rates on any new bank reserves resulting from its asset purchases. So all existing bank reserves, that's around $2.5 trillion or 50% of gross domestic product in Japan, will continue to be paid at an interest rate of plus 0.1%. So it's unlikely to be any impact on bank profits or bank depositors in the short term. The negative interest rate will only have an impact over time as the BOJ keeps buying assets and creates new bank reserves. So essentially what they've done then will come into fruition as their QE program continues, and there'll be those exact targeted reserves that will come into play in terms of a negative rate. So it's not like the ECB when it's an entire kind of cut and dry negative deposit rate. It is slightly different. So hence the reason I think why you had a bit of a pullback from the initial kind of euphoric move seen in Japanese assets. But undoubtedly, it is kind of the next policy step. So Nikkei was higher and the Japanese yen is still significantly weaker in the FX markets. So top 2 charts here, looking at the ramification for the European Open, we gapped up. As mentioned, Nikkei up just shy of 3% then at the actual close. So the DAX, Eurostox higher at the open. And in this kind of classic QE type trade, Bunds also gapping up. So rather than the normal inverse relationship, again, this is the kind of usual price action that we've become accustomed to through the last few years of QE. Bunds, again, these are record levels for the bunds. JGB yields are at record lows. And these Bund at the moment just finding a bit of resistance around that psychological 163 for the time being. A little bit further fueled by the fact that the DAX has come off slightly as oil prices have also just drifted a little bit lower, failing to sustain a move above 34, which was seen briefly at around the European Open. We have pulled back slightly here, albeit we're still up around 50 cents. Otherwise, another point of note, just to wrap things up with Asia, is the People's Bank of China. They're again done large liquidity injections overnight, and they've said they'll do further open market operations. These are essentially kind of the mechanics of keeping their economy liquid, and they've been really pumping a lot more liquidity into the system than would be normal, but this is a kind of seasonal thing. So it's something which we see always at the beginning of the year, and it coincides with Chinese New Year, which kicks off on February the 8th. And the reason they pump the system full of liquidity, so this is slightly different to the fact that they're looking to intervene or anything of that nature. Shanghai has been a little bit more steady rather than at the beginning of the year. It's more so just to facilitate the fact that Chinese markets completely shut down for an entire week during Chinese New Year. So they have to awash the system with liquidity. We're just moving on then, taking a look at oil, because that was the big driver of markets and sentiment yesterday. So a quick recap. For any of you interested as well, we did put a video that Will...
No, that Rick's thanks you got connected.
There was a video that Will did yesterday where he talked through some of his trades and how he navigated the kind of headline news and how he executed his trading strategy. That is available on YouTube on our Amplify Trading channel if you want to take another recap on that. But a quick look at these oil prices from yesterday. As I've mentioned a couple of times, headline risk is getting more and more important for oil. I still think at some point Saudi Arabia have got to say something. I think the reason probably that they haven't is because they're scared about how the market might interpret what they say. Kind of a bit of a double-edged sword, really. As Saudi say, we're not bothered, we're definitely not meeting, we're not looking at cutting production, then that could be negative for them. It could push prices back down quite drastically again. Or if they intonate towards possibly leaning towards the Russians, then that could mean them losing a bit of power and almost handing out reins over to Russia, which is the last thing they'll want to do. So that's probably the reason that's keeping them quiet at the moment. But as I was talking about yesterday, when we hit around this peak, which came after the Russian energy minister said about a 5% cut talks may involve all producing nations, the thing that we were looking at was the reason why we were pulling back. And I think that was because Saudi hadn't commented. But you can see the severity of these moves. And if, like Will was talking about yesterday, your decision-making time has to be super fast if you want to take action on these moves. Now, we saw that news break originally on Twitter. So again, you know me, guys, I'm a big fan of fundamentals and Twitter and breaking news. So definitely caught it there first and able to encapsulate that move. But then it's also about understanding when other people see the news. Reuters ran it after Twitter, and then Bloomberg didn't run it for possibly 30 seconds after. And that's your period then of your potential entry points, because then you get a second and third win out of the news. So oil, still keep an eye on that today. In terms of the actual calendar of European events, overall, it's pretty quiet. We've already seen a bulk of the main things. It's got the Eurozone CPI at 10, but I don't really think that's going to have too much of a market impact because it's more of a US day-to-day today. So in the interim period, I would just be mindful of these oil prices. The DAX already this morning finding a little bit of support around that pivot level. But if oil can make another push to the downside, then that could put pressure on that pivot level. So I'll just be looking at oil here, early morning. If we stabilize here, that pivot level may well hold, although we're just testing it now as I speak. Again, the ability to break that level convincingly may well be whether oil can make another move lower here. So still a big driver of the markets in that correlation trade. Otherwise, I'm just going to quickly bring up the calendar and have a quick review then. As I mentioned, it's a busy US day in terms of data. Moving down to the US session, the big piece of information will come in the form of the GDP annualized figure. So this is the advanced reading for the fourth quarter. That's the most important of these three US GDP readings. It's the first time we get to see an indication of growth in the US for that specific period. So that's expected at 0.8%, but you can see here, because it's the first time we're going to see it, there's an incredibly large range of what surveyed analysts are expecting, down from minus 0.2 all the way up to plus 1.7%. So there's a real big range here about what we could potentially see. So that'll be at 130. That'll be alongside the employment cost index and then the Canadian GDP figures for anyone who trades that currency. Then later on as well, another important data point is the Chicago Purchasing Manager. That'll be at 245, followed then by the Michigan number, but that takes slightly less precedence given the fact that it will come after a lot of these other bigger data points, and it's the final reading for January, so we've already seen the preliminary figures. Otherwise, in terms of speakers, very quiet throughout the day. ECB's Costa is not until after European cash equities close, and then Williams, non-voter, is talking more towards the close in Wall Street. We've got around 18 companies reporting for the S&P 500, so I mean this is comparative to something like 85 that we saw on Thursday, so it's much quieter. That is usually the case on earnings season. Mondays and Fridays are very quiet for earnings. However, we do have Chevron reporting pre-market. I'd imagine they'll be around 1 o'clock type of time, and that will be very interesting to see how much they've been impacted, obviously, by this huge fall that we saw at the end of last year in oil prices. Otherwise, then that wraps things up. So as I mentioned before, still keep a very vigilant eye on oil prices. There is still a bit of headline risk about Saudi possibly commenting or Russia changing tact once again. So just be, ready to go if the situation does start to change again. You can really see how the entire market, irrespective of asset class, gets driven when there's a big breaking fundamental story. Then the picture can change quite drastically. So just be ready for that. And then until later on, US data will be key. So have yourself a great trading day. For the guys in the respective courses, for the month 3 guys, this is your final day. Irrespective of where your P&L might stand, let's make it count, finish on a high, and let's go out with a bang. So have a great day. Thank you.